Yo, what's good, guys? Okay, so at the request of everyone, I'm going to be doing a few videos which are going to just break down everything that you really need to know and understand about these patterns, about moving averages, about entries, exits. It's all going to collate to just a small series of videos which will help you, okay? Help you as the new trader come into this game with some foundation so that you're not trying to second guess, should I say, in the streams. The nature of the streams themselves are designed to help you apply this knowledge in real time, because let's be honest now, all right? You can only look at something in hindsight for so long. You need to actively be aware of how to apply it in foresight. You need to be able to prepare your mind for what's to come. Can you visualize the W? Can you visualize the M? You know, where are you looking and what are you looking at? That, you know, there are so many questions that people ask, and the problem is you're starting to complicate it. You really don't. All we need to find is an M formation and a W formation. It's easy for me to say. Granted, I've got years behind me from watching charts, and I'm not going to be naive into thinking that you guys are just going to come in and just take it for what it is and be like, okay, happy days. I'm a trader now. All I've got to do is find an M and a W. Although I have received messages from people that I've only absorbed only 15% of what I've been talking about, and they're making a killing. Can you imagine that? So let's get straight to it. What is an M and what is a W? So before we get into anything, most of you have probably seen me draw this pattern near enough in every stream. Granted, I'm always addressing all the new people that come into the stream. I mean, I'm trying to balance as much of it as I can. I've got people that don't want to be hearing the same shit. I've got people that really want to hear as much of it as possible. And then trying to find the balance. But understand, guys, it's like when a teacher has to repeat himself continuously. He's going to go over the same thing over and over again because there is someone new that will want to know the basis of it. Now, for anybody that has been in the streams and they're continuously hearing the same thing, it's you guys that are going to be able to go forward and teach people. It's you guys that are going to be able to be proficient in this strategy. Because this strategy, do not become complacent. Do not think, yep, I've got the pattern in the back of my mind. Happy days. You know why? Because when money's on the table, all right, you start to behave in a funny way. Market makers make you do that. When it comes to having money on the line, you tend to just get rid of all of what you've known before, because all that's running in your mind is adrenaline. You know, you're starting to feel anxious. Price is going against you. You thought that you got the patterns down to a T. If I don't repeat all the stuff that I say to you all the time, if you're not taking it in, you are effectively opening yourself up to the market maker. This is the key. The market maker will always test you. He will always test your ability as a trader. Now, whether you want to accept the market maker as a sort of a matrix, a metaphorical boss in like a computer game, whatever you want to see it as, ultimately it's you against you. As Most Dev puts it, I against I. All right? You are the reason why you trade. You are the reason your trade is profitable. You are the reason why your trade is a loss. You are the reason why you stick to your stops. You are the reason why you do everything in trading. It's on you. No, in no way are you going to be in a position, should I say, to push on the blame to someone else. If you can't stand your ground and accept responsibility for everything that you do in this game isn't for you, straight up. And I will put someone off the idea of trading as soon as I can if they are not showing the mentality and understanding that this game takes no prisoners. Finished. They don't care. Market makers, I say it before, market makers don't care who you are before you place a trade. They only care about the money that's on the table. They don't care who it's from. Remember, the dealers, the brokers, they only see your balance, your account number, and the margin that is involved. That's all they care about. Why? Because to them, that's where the money's at. You are the liquidity. Now, it's only when you are smart and understanding the system where you're able to avoid getting caught up in the chaos that these market makers make retail traders think. Now, I will say there have been people that have challenged the concept. Fair game, right? You will never catch me complaining about those people again. If they want to say something, moderator's going to take over and deal with them. I ain't going to waste my time with these people. Okay? That's that. Next topic. What do you need to understand about the M and the W formation? Well, let's look at how things are on a weekly basis. This is the pattern right in front of you. Okay? You can see W formation, M formation, W formation. Where are you likely to see W's? W's appear below or at moving averages. So if I bring it to this chart here, here's a W formation right there. All right. You can see the W formation is at the 200 day, which is this dotted line here. I've just set up a different indicator, sorry. So let me just put that indicator just to make life easier and consistent with what we actually do. Right. There you go. Happy days. Oh, got to get rid of all of those mad things there. Let's get rid of them. Get rid of the arrows, show trend, show arrows. There we go. Cool. Done. Happy days. All right, cool. 200 day is right there. And the 50 day moving average. W's always appear at the moving averages. They usually appear when price is away from the moving averages. So here's another example. You can see a W formation. The best one to use, I mean, that was a good one. You could use this one. So W formation, you could take the first leg down, right? You then have a rise, and then you have a retrace, and then you have the continuation to the upside, all right? You know, all below the moving averages or at. So just remember, rule one, the W formation always appears below a moving average. Get that down. I'm going to make sure that this is clear and cut, guys, okay? I'm not going to beat around the bush, all right? You can just play this video back to back. Second, M formation. The M formation appears at the highs, all right? It appears at the highs and it can appear above moving averages. So here's an example. There's your M formation right there. It is appearing above the 50-day and the 200-day. Granted, you do sometimes see M patterns appearing. I mean, look how close that is to the moving average. All right. You also can have smaller M patterns. For example, there is one right there. You can have the rise up to there. Here you go. You can have a rise. You have a retrace. And then a very small continuation up. And then a drop. Right there. Okay. The fundamental rule of the M's and the W's is this. The bigger the pattern, all right, the better the conviction of the breakout. This happened over a long period of time. That didn't. Now, if you start counting all the candles in here and then you count the candles in here, granted, you're going to have more candles in here than you are going to have here, all right? But the best thing for these patterns is this. The bigger the volatility inside the W formation and the M formation, the greater the chance that the pattern's going to play out. All right? Look at this. Notice what happens here. You've got price drops, pins the low with the big stopping volume candle, retraces, pulls back, shows support at the 200-day, and then out she goes. Shift candle right there. Now, a shift candle is a candle that tries to take price out of the consolidation zone. All right? I'm going to get onto that in a short moment. What I need you to understand is W's and M's appear at or below moving averages, which is the W, and M patterns appear at or above moving averages. All right? So, let me bring it back to here. So, we've established the W formation, the M formation. Don't overcomplicate it. Appears below a moving average. That appears above a moving average. Okay? Done. Next. The second move from the W formation needs to be an aggressive move to the outside. It needs to come away from the moving from the W formation. Okay? Now, what is a W formation and what is an M formation? Well, if you understand the psychology behind it, you're then able to see the pattern bright as day. People are coming into this just trying to find an M and a W, and I've seen some fantastic M's and W's, right? But I'm not blaming you guys because I'm effectively coming to you with a different concept of trading. All right. So what constitutes a W? Let's look at the psychology. Let's go back into the main price. So the first thing about a W formation is this. The first leg has to have vector candles. All right. Now I'm saying you're going to see a lot of M's and you're going to see a lot of W's. They are there to throw you off. But what you want to look for is you want to see aggressive behavior by the market makers to push price down, to induce traders to believe that price is going to keep going down lower. Why? Because the market maker, wants us to believe that by sending price lower, there's weakness in the chart. But what's really happening is the market maker is building his longs. All right. So here's the example. Market maker steps in right here, breaks the 50-day moving average, price collapses. He's tricked all the retail traders in the belief that the 50-day has broken down. It's now time to go short. So they go short. And then he does it again, rejects the 50-day moving average. Look at the pin there. And then he pulls price back down. All right. He pulls price back down because he knows there are orders at the 200-day moving average. People have got orders set there. That's why he's pinning the lows of the moving average. Look, pin to the low, massive pin to the low. When he broke the 200-day moving average here, all right, he had triggered so many guys to go short. They thought it was happy days. They were ready to go down to the depths of hell. All right. But then what did he do? He snapped price all the way back up. So this would be deemed as our first leg of the W formation. What do we then expect? We then expect price to retrace back up. Why? Because the market makers created the illusion that price is dropping to the downside. So the guys that are entering short here, all right, let me just zoom in to make life easier. The guys that are entering short in this area here, he's making them believe that by price dropping, they want to make sure that they're getting their stops put in place because they don't want to miss out on a good thing. All right. So what they do is they put their stops and then they put their stops closer and closer to their profit point. All right. Once it breaks the 200-day moving average, the guys who've got their stops up here are comfortable. They don't care. But then what happens? Once the market maker has obtained enough liquidity to get his longs filled at lower prices, he reverses price back up to the 200-day moving average. He effectively squashes out all the guys who set stops in this zone here. Then he comes back and works the previous zone. He takes out all the guys' stops who went short and put stops in this area here. And he comes back to the 50-day. The 50-day moving average tells the retail trader that there's going to be an area of resistance. Because look, they spike the high and then they come back down, spike it again and finish down here. So retail traders are thinking, oh, great. I've been stopped out. I've got another opportunity now to enter because this move to the downside is going to continue. So he then induces more retail traders to get short at this area because they are trading off the bounce of the 50-day moving average. Okay. Then what happens? He starts breaking down and he gets aggressive in this area here, comes below the 5 and the 13 EMA, doesn't go below the 200-day, but that is enough. That candle there was enough for him to trigger all the shorts in this area to step back in. And then what happens? He opens the candle here, drops below this previous area, solidifies the conviction of the retail trader that price is going to continue lower. And then before you know it, the next candle, he shifts completely out of the zone. This shifting out of the zone is the market maker taking all the liquidity from all the guys in this area here and using it to get his longs filled at higher prices. In other words, he's in a markup phase. He now realizes a profit on his longs. All right. Pay attention. Red candle, look right. Red candle, look right. Red candle, look right. They are closing the previous positions, even up to here as well. Look at that. Okay. Are we seeing it, yeah? Happy days. So, once they've achieved that, this is what you're looking for. You're looking for a fast, aggressive move out of the zone. Because if they don't get out of there, the market maker is exposing himself to loss. Because then the selling pressure will be overwhelming, all right? And the market maker will have to acknowledge that, and he will then be in the negative position. You know, the market maker can be in a losing trade. But the problem is the market maker has enough money to sit in a losing trade for days on end. He knows where he can make his money. As retail traders, we don't have that luxury of having so much money, but we don't care about our loss. We won't know where price is going to go next because the market maker can switch it up at any point. We have to be smart. So, W formation, that has been effectively achieved. All right. Now, an entry for the W formation is pretty simple. All right. But there's a lot that needs to be considered. If you look at the W formation right here, you can effectively see the pattern. All right. If I draw this pattern to the high up here, in hindsight, it's easy to say, but your entry would be at the top of the W right there. What has to happen is price needs to close in the first instance on the hourly. Price needs to close above the 50-day moving average and the 5 and the 13-day EMA. That's what has to happen for you to verify that the pattern of the W formation is coming out of the zone. All right. Watch what happens here. Price does break out from the previous high, but then it comes back to retest the 50-day. Always wait for the retest when price breaks out of the pattern. Sometimes you don't need to wait, but always have in your artillery an expectation that you need to wait for price to come back down and test the 50-day moving average. If it does come back and test it and it's fine, happy days, stay in the trade, out you go. All right. This is where the 2-hour rule comes into play. The 2-hour rule is important, and I'm going to do a whole different video on the 2-hour rule so you guys have it for your own disposal. Okay? So we are safe on the knowledge and understanding that the W formation, all right, requires that you have to have a strong vector candles to the downside. You need to see a retrace back to the 50-day. The 50-day needs to move price away from that zone, and then price cannot exceed lower than the first leg. Granted, there have been instances where you've seen the second leg take out the first leg, all right? But that is because the market maker wanted to just take out a little bit more liquidity before he started making his move. The only way you can verify whether a second leg is okay for it to succeed the first leg, all right, is you look at what the candle does. So, for example, let's go over here. I mean, the best way to really show it to you, typical, innit? Trying to find that pattern and it's not there. Here we go, here we go. Although it's short-lived, all right? Look at this. This W formation that appeared here. There's your first leg. Not many vector candles. Short sell-off, all right? Rise. And then we've got the retrace. The retrace is more than the previous first leg. However, look what happened. The candle itself came back, spiked down, and closed above. It closed above the previous zone. Can you see that? So there's the close of that candle. You look left, you can see it's above the previous wick. That is relevant. That is a valid W. Although this W didn't last very long, you still could have traded it by entry at this point here. Yeah? You could have taken at least how many pips to the 50-day moving average? 230 pips. Happy days. I'm happy with that. All right? Cool. That is your W formation. That is effectively what you're waiting for. Same story here. You can see it. Price drops all the way down. Aggressive vector candles. Pinning the lows, pinning the lows. One, look, railroad tracks right there where the lows, near enough, the lows are the same as on each candle. All right? Comes back to the 50-day moving average, induces more retail traders to go short, comes back down, tests the 200-day, breaks it, reverses back again, comes back down, forms the second leg, and then before you know it, shifts out of the zone. Price is above the 50-day, the 200-day, and the 5 and the 13 EMA right here. Make your entry, up we go. So where's your entry on this? So if we consider that this would be the absolute max entry point, all right? Or we consider this as the absolute max entry point, and then you can use this as an advanced trade entry right there. All right? You be the judge. You be the judge. The patterns are not static, guys. They are not static. All right? It's about how you express yourself in your terms of understanding the patterns themselves. All right? Because the reason why these patterns aren't static is because the market maker changes shit up every time. Okay? So there you have it. What are M's and what are W's? Just as I said a moment ago, the patterns themselves are not static. There will always be a variation to the theme. And you've got to prepare your mind for that. Don't start losing your mind if you can't see a pattern or it's not coming out the way you want it to be. The whole idea is to wait for it to play out. There are so many entry points with the W and the M formation. All right. The idea is to try and grab the moment the market maker wants to come away from the zone. Our goal is to effectively ride the move when the market maker wants to get out of the zone because he has committed all of the retail traders' money in the opposite direction. All right. Now, I hope this has served you guys. We got plenty more videos coming. I'm trying to get as much of the information into videos as soon as I can. All I ask is you just bear with me, guys. Trying to hold it down for you. Mad love to all of you.